Wow. I was sitting there thinking it might be worth retraining as a lawyer because, quite honestly, there seems like there's going to be an awful lot of work to do. Okay, I'm going to say a few words on the business perspective of Brexit and taxation. My comments are personal and they're related to business in general, and they're not specifically related to Unilever. So the decision on the 23rd of June last year was as momentous as it was unexpected. But business fundamentally is pragmatic. And by and large, business just simply wants to get on with things and make the necessary changes. However, in order to plan for those changes, you need to know what the plan is. This is essentially the chicken and egg situation that we find ourselves in today. A few things have actually changed since last year. In particular, post the US, French and UK elections, the political landscape has shifted significantly. So as business, we find ourselves wrestling with the same challenge, but in a different environment. Importantly, it seems that there's a fresh opportunity now for business to play a constructive and pragmatic role in helping the government deliver as painless a Brexit as possible. And on the 17th of June, the 5 organisations you see here, the CBI, the Federation of Small Businesses, the British Chamber of Commerce, the Institute of Directors and the Manufacturers Organisation, jointly wrote to Greg Clark urging the government to put the economy first. And 3 key elements are called for: no cliff edge and sensible transition arrangements which give businesses the space to plan, and providing early reassurances to EU citizens in the UK and UK citizens in the EU, and maintaining an open border between Ireland and Northern Ireland and Ireland and the UK. The economic principles advocated by business should also be no surprise. These are all the kinds of things that help to facilitate cross-border trade in goods and services. Particularly for the first 4 items on this list, any increase in tariffs, customs formalities, differences in regulatory requirements, for example, in packaging and labelling requirements, or consumer safety or similar standards, any increased administration related to hiring people, this all translates into higher costs for the business concerned. Participation in pan-European programs that bring broad benefits is clearly something that businesses would support, in the same way as participation in similar programs with other countries outside the EU. And the EU has negotiated many free trade agreements. Replacing these with bilateral free trade agreements will take considerable time. However, there may be positives as well as negatives here, depending on the interaction of this topic with whatever terms the UK manages to negotiate access to the EU market on. So we simply don't know the answer on this one yet. So in summary, Brexit will have impacts on competitiveness, and that's important because businesses, why do they exist? They want to provide goods and services to consumers that are affordable, of the right quality, and which are produced sustainably. And now turning to the specific areas of impact on competitiveness. Firstly, many businesses have very extended supply chains. If there's a cost every time an element of the supply chain moves across a border, whether from the EU to the UK or the other way around, this will motivate a couple of responses. Either you reconfigure your supply chain to eliminate that cross-border movement, or you try and deal with the cost, which usually means that the business absorbs the costs, or it tries to make offsetting savings, or there may be scenarios where the cost needs to be passed on. The cost of change, secondly, can be quite significant, especially where it impacts on IT systems, and this could well be the case in the area of customs and indirect taxes. So I know from my own personal experience that just a simple change, like changing the legal entity that might own the inventory in your supply chain process, can actually cost figures in the millions of pounds to fix and take a considerable amount of time in terms of the project team required to work on it. So this is not something where you can flick the switch. Thirdly, once the new administrative tax and customs compliance framework becomes clear, there will be changes to processes which will have impacts potentially on people costs. Now, I'm trying to be cheerful, so I think there's also an opportunity here, because whenever you have to change something, there's an opportunity to automate, introduce technology, and to leapfrog and get improvements in productivity. So if you have to do something, at least you may as well try and get some benefits from it. So, as some of the previous speakers have mentioned, the UK's tax system really has become more competitive over the last 10 years. The key improvements are shown on this slide. And it will be a critical advantage if the UK is to be attractive as a future place for businesses to invest in, but also for businesses to base their activities from. Particularly in supporting business innovation and improvements in productivity, tax policies in this area are key. But this also needs to be backed up with a tax administration that is balanced and proactive. Otherwise, the benefits of a competitive tax system are more than outweighed by the negatives of uncertainty, and we've heard a lot about how important tax certainty is earlier today. The perceived tax competitiveness of the UK system may also be seen as an unfair advantage once freed from the reach of EU tax harmonisation projects. So clearly there is a judgment to be drawn between where does the limits of tax sovereignty, where do they end, and where does unfair tax competition begin? And like all matters subjective, there are going to be different points of view on this. So that's why it's always good to start with the facts. And I found this an absolutely surprising chart. It shows that UK corporate tax contributions as a percentage of GDP are actually the third highest in the G7. So this is interesting. The UK has a low corporate tax rate, but that doesn't necessarily mean that it collects less in terms of corporate tax contributions. Now for some specific tax items, because after all, this is meant to be a discussion about Brexit and tax. So the EU has two tax directives that are important, very important to businesses in the direct tax space. The first is the Parent Subsidiary Directive, and the second is the Interest and Royalties Directive. They're designed to eliminate tax obstacles associated with different types of payments between members of the same group which have subsidiaries within the EU. So the types of payments impacted are dividends, interest, and royalties. And without the benefit of these EU directives, a UK recipient of dividends, interest, income, or royalties would have to rely on the protection of the UK tax treaty instead. At the moment, it doesn't have to think about that because the directive applies. And the same is also true in reverse. So if you've got a payment of interest or royalties that's going from the UK to an EU recipient, that recipient may also be relying on the EU directive. So the UK tax treaty network needs to address any gaps between with the EU directives once they no longer apply. So to give you just a couple of examples of where that might be relevant, in the case of dividends that are going to be paid by subsidiaries in Germany and Italy to a UK parent, without the directive, the Parent Subsidiary Directive applying, the withholding tax rate in most cases there would be 5%. And taking a situation in the opposite scenario, where you've got royalties paid by a UK entity to, say, an owner of IP in Luxembourg, a withholding tax rate of 5% would apply on a treaty basis, compared with the EU directive position, which would be 0. in all cases providing the qualifying criteria are met. And then in the cases of UK subsidiaries of an EU parent, it will need to be confirmed whether the participation exemption would apply. In other words, whether the dividends from the UK subsidiary would not be subject to tax in the hands of the EU parent. And I will conclude on this last slide, which is just to warm you up for lunch. It's a bit busy. And I must give credit actually to Lydia for this slide. The basic rate for withholding tax on US source income, like dividends, interest and royalties, is 30%. However, under US tax treaties, this withholding tax rate is often greatly reduced, sometimes to zero. However, there are provisions in most of the US tax treaties to prevent treaty shopping. What's this? This is to ensure that the tax treaty benefits are limited to those people who are intended to qualify for the benefits. And the provisions generally provide that in order to take advantage of that tax treaty, the ultimate beneficial owner of the income has to be a qualified person in the country which has the treaty with the US. So, for example, a favourable treaty that the US has with country X will not benefit a company organised in country X if that company is ultimately owned by a tax resident in country Y, and country Y doesn't have a tax treaty with the US. So that's quite convoluted. There are various exceptions to the qualified person principle, and this diagram is designed to illustrate where treaty benefits that you might expect ought to be available actually in the post-Brexit world, where the UK is no longer part of the EU, may no longer qualify. So if you just take the example on the left, where you've got the UK subsidiary of a US parent, and the US parent is owned 40% by US shareholders, 6% by UK shareholders, 30% by French shareholders, and 24% by Canadian shareholders. The first test is that for payments, and let's assume it's a dividend payment coming up from the UK subsidiary to the US parent, the first test is that 50% of that UK entity must be, the US entity must be owned by 5 or fewer entities residing in the contracting states of the treaty, in this case the UK or the US. So in this scenario, because the ultimate shareholders are 40% in the US and 6% in the UK, if you're just looking at UK and US parties, you won't meet that 50% threshold, so you fail on that count. But don't worry, because there's another derivative ownership test that you can look to. And this one says that if the beneficial owners of at least 95% of the vote and value are, and there must be 7 or fewer of them, if they're members either of the EU or NAFTA countries, then you will qualify. And in this particular example, because our scenario here is that the UK has now left the EU, it's no longer a member of the EU, it owns 6%, so you're past the 5% headroom that you would have with the 95% test, and because of that, you would fail the ownership test. And so that's just an illustration of a more technical issue that arises out of the UK leaving the EU. Clearly, a solution needs to be found for this, and I'm sure that one will. I'll end on that happy note.